Silver has more than doubled in the last year. In the last 6 months alone, it's up over 100%. Right now we're trading in the mid-70s, roughly $75, $76 an ounce, even after a couple of red days. For a lot of people, this already feels like a confirmed bull market. I'm seeing comments like, "It can't go back down now," and "This time is different." That's exactly when you need to ask the opposite question. What would actually have to happen for this silver bull market to fail? What would it really take to end this rally? Welcome back to Data Over Hype. Thanks for being here. Before we get into it, I need to repeat something clearly, especially if you're new. I don't sell courses. I don't sell mentorships. I don't run a private group. I don't sell trading signals. If anyone uses my name or this channel's name to offer you anything, block them. I'm only here on this channel and on the official links in the description. That's it. I'm not here to sell you hype, fear, or greed. I'm here to walk through the structure of what's happening so you can think for yourself and make your own decisions. Over the past videos, we've looked at the crash in paper silver, the explosion in physical demand, how margin hikes and positioning create violent moves, and whether the current bounce is a real bottom or just a trap. Today, we're going to flip the question completely. Instead of building a bullish case, we're going to stress test it. I'm going to walk through 3 big ways this silver bull market could still fail, even after a year of massive gains. None of these are predictions, they're scenarios. Your job is not to pick one and marry it. Your job is to understand what they would look like so you can recognize them if they start to develop. Let's start with the first one. The first way this bull market could fail is a macro rug pull. Silver didn't double by accident. It moved in the context of a very specific macro environment. Years of aggressive money printing, negative or deeply negative real interest rates, concerns about inflation, worries about currency debasement, and a broad search for hard assets. When people lose confidence in policymakers and in the value of their cash, precious metals usually benefit. Now imagine the opposite. Imagine a world where real interest rates move decisively higher and stay there. Not a one-month blip, but a sustained period where holding cash and bonds actually pays you a real return above inflation. Imagine central banks not just talking tough, but following through with tighter policy for longer than markets expect. No panic pivots, no emergency QE, just boring, grinding, restrictive policy. At the same time, imagine inflation cooling more than people think possible. Not zero, but low enough that headlines stop screaming inflation crisis and start talking about disinflation and even over-tightening risk. In that world, the emotional justification for owning silver as an emergency hedge starts to weaken. If you can sit in high-yield cash or safe bonds and earn a real return without volatility, a lot of marginal money that rushed into metals can leak back out. Add a stronger dollar to that picture. If global growth slows and there's a scramble for dollar liquidity, you can get a dollar squeeze. Emerging markets under pressure, funding costs rising, trade flows disrupted. A stronger dollar mechanically puts pressure on dollar-priced commodities, including silver. In that macro rug pull scenario, silver doesn't collapse because the metal suddenly became useless. It corrects because the conditions that fueled the run are reversing. People who bought it primarily as an inflation hedge or dollar hedge start to unwind. Some are forced out. Some just rotate into whatever the new macro trade is. You'd likely see positioning shift. Speculative longs shrinking, ETFs bleeding flows, central banks may be dialing back marginal buys, and media narratives drifting away from hard assets back towards safe income or tech growth or whatever the fashionable theme becomes. If you are only bullish silver because you assume inflation will explode forever and real rates can never go up, this is the first risk you need to take seriously. The macro environment doesn't have to stay friendly to your trade, and it absolutely can overshoot in the other direction. The second way this bull market could fail is internal. The bull market overheating into a full-blown mania and then imploding under its own weight. We're already partway down that road. When an asset is up over 100% in 6 months and more than 140% in a year, you have to assume a lot of late money came in during the upper part of that move. Early stackers and long-term holders have already been rewarded. But as price rises, you attract a different crowd. Leverage goes up. Time horizons shrink. People start talking less about ounces and fundamentals and more about price targets and daily percentage moves. In a classic blow-off phase, you see several signs. Parabolic charts with steeper and steeper slopes, social media activity exploding, new products being launched to let even more people speculate with even less understanding. Stories everywhere about how you can't lose because demand will be infinite, and this time is different. People mortgage homes, borrow against portfolios, or use extreme derivatives to chase a commodity that has already doubled or tripled. If silver enters that kind of final acceleration, say we go from the mid-70s to some huge headline number in a very short period without any real consolidation, it sets up the conditions for a brutal hangover. All it takes is one shock, a macro scare, a policy comment from a central bank, a surprise margin hike from the exchange, a big fund blowing up, or even just the absence of new buyers at ever higher levels. Price stops going up, and that's enough. The entire ladder of leverage above it begins to shake. Late longs, especially leveraged ones, start to sell. Stops cascade. Algorithms flip from buy the dip to sell the rip. Margin requirements increase. Positions get liquidated. Price falls faster than anyone thought possible. You get the same type of violent flush we've just been talking about, but from an even higher starting point, and with even more emotional damage. In that scenario, the bull doesn't end because the long-term thesis was wrong. It ends because too many people tried to compress 10 years of gains into 10 weeks using other people's money. The future demand for silver gets pulled forward and then exhausted. It can take years to rebuild confidence after that kind of boom and bust. If you find yourself daydreaming about silver prices that sound like lottery numbers, and you're thinking about maxing leverage because it can't possibly go back below X now, recognize that you may be stepping into exactly the kind of late-stage behavior that often marks tops. The third way this bull market could fail is from the physical side, demand and supply turning against the story. One of the strongest pieces of the bullish thesis is that silver is both a monetary metal and an industrial metal, with growing use in things like solar panels, electronics, electric vehicles, and medical applications. The idea is that you have investment demand colliding with real-world industrial need, all against a backdrop of constrained mine supply. That's powerful. But that picture is not immune to change. Imagine a sharp global slowdown or outright recession. Industrial activity contracts, major silver-using sectors cut orders, solar installations get delayed, governments pull back subsidies, tech and auto companies slow production. In that environment, industrial demand for silver can drop meaningfully. Investment demand might hold up for a while, but if investors realize that a big chunk of the demand growth story is stalling, they can start to question the inevitable deficit narrative. Now flip it to the supply side. When prices double, projects that were uneconomical at $30 suddenly look very attractive at $70 or $80. Miners restart marginal operations. New projects get financed. Existing mines are pushed harder. Recycled silver comes out of hiding as higher prices motivate people to sell old inventories and scrap. It takes time for this to show up, but when it does, you can go from tight market to more metal than people expected, surprisingly quickly. Add possible substitution. If we continue to see very high silver prices, industrial users have an incentive to engineer around it. They might use less silver per device, switch to thinner coatings, or in some cases move to alternative materials. That doesn't happen overnight, but history shows that sustained high commodity prices invite innovation and substitution. On top of all this, you have the risk of policy and regulatory shocks. Governments have, in the past, stepped into precious metals markets through taxes, restrictions, or sudden rule changes. An example would be a government slapping extra taxes on miners, or changing how metals are treated in certain financial products, or even imposing new reporting requirements that scare off some investors. Exchanges can change contract specs, position limits, or margin rules in ways that alter how paper markets function. If you combine weaker industrial demand, a supply response, some substitution, and a few unhelpful policy moves, you get a very different physical backdrop than the one bulls are assuming today. So those are three broad ways this bull market could still fail. A macro environment that turns against hard assets, a speculative blow-off that ends with a crash, and a physical market that no longer looks as tight as people expect. Again, none of these are guarantees. Silver could navigate all three risks and keep grinding higher over the next decade. The point is not to terrify you out of a position. The point is to challenge the mental model that says, it went up a lot, therefore it has to keep going up. So what do you do with this? First, you make sure your bullish thesis isn't a one-liner. Number go up is not a thesis. If your entire reasoning is, it doubled so it will double again, you don't have a plan, you have a hope. Second, you ask yourself honestly, if any of these risk scenarios started to unfold, what would I do? If real rates start rising and the dollar rips higher, do you have a trigger that tells you to reduce exposure? Or are you just promising to hold no matter what, because that's what anonymous accounts on the internet told you is noble? If silver goes into a clear mania phase and the behavior around you looks insane, do you have the discipline to take something off the table? Or will you tell yourself that this time there's no such thing as a top? Third, you separate your long-term stacking from your trading. If you're buying some physical metal because you want a hard asset hedge over a 5 or 10-year view, these scenarios matter, but they don't require you to micromanage every daily candle. If you're trading leveraged paper instruments, these scenarios matter a lot. The wrong combination of macro shift, margin change, and crowding can and will liquidate you, regardless of the long-term story. And I need to say this clearly, as always, nothing in this video is financial advice. I'm not telling you to buy, sell, or hold anything. I don't know your situation, your goals, your obligations, or your risk tolerance. My job here is to map out the landscape so you're not driving blind. If you've watched this far, I want to hear from you. Which of these 3 risk paths do you think is most likely to challenge the silver bull over the next couple of years? Macro reversal, speculative blow-off, or physical demand and supply turning against the story? Drop a comment and start it with either macro, mania, or physical, so I know where you stand, and tell me why. You might see something I haven't talked about yet. If this kind of analysis helps you cut through the noise, seeing both what could go right and what could go wrong, consider subscribing to Data Over Hype and turning on notifications. We'll keep tracking silver, gold, and the macro backdrop with as much honesty and clarity as we can. Use your own brain. Stay within your limits. Don't follow anyone blindly, including me. Thanks for watching. Take care of yourself, and I'll see you in the next video.